The biggest institutions on the planet just moved, and most people have no idea it happened. Silver just closed at $84.59. That number matters more than you think, because what just changed this week is not showing up anywhere people are looking. If you are new here, subscribe to SHF Money right now and like this video. We cover what the big players don't want you tracking. Stay locked in because the window on this is narrow. Let's talk about what is actually happening. The precious metals complex just had one of the most dynamic sessions it has seen in months. Friday, February 20th, two catalysts hit the market at the same time. The first was the PCE inflation report. The second was a Supreme Court ruling that reshuffled the entire tariff landscape. Both hit within hours of each other. Both sent capital flowing in the same direction. Gold surged 2.42% and blasted through 5,000, clearing $5,118. Silver didn't just tag along, silver ran. It closed near $85.32. That is not a follow-along move. That is a metal finding its own engine. And here's the part most people miss. Silver has two engines that gold simply doesn't have. Gold is a monetary metal. It is the hedge against bad decisions made by people in expensive suits. Silver is that, and it is also the backbone of the industrial world. AI chips, solar panels, electric vehicle batteries, military technology, satellite systems, nuclear energy infrastructure. Silver is inside all of it. When monetary demand spikes, silver benefits. When industrial demand grows, silver benefits again. That dual engine is exactly what fired up on Friday. Monetary demand came from gold's breakout. Industrial demand came from the tariff ruling reshaping global trade flows. Silver was sitting at the intersection of both. Capital flooded back in, and that momentum is not done. Now let's talk about the Supreme Court ruling, because this is where it gets important. The decision clarified the legal framework around trade policy in a way that traders interpret it as a signal. Supply chains are going to shift. Global trade flows are going to realign. And when that happens, industrial metals benefit because demand for them gets repriced. Silver was already moving before the ruling was final. The ruling confirmed what traders had already started pricing in. That is how institutional money works. They move before the news. By the time the headline hits, the position is already on. The question is whether you are already in or whether you are watching from the outside again. Here is what you also need to understand about the tariff situation. It escalated further over the weekend. Temporary tariffs on nearly all imports were raised from 10% to 15%. That ceiling is set by a specific legal authority that also requires congressional approval if tariffs extend past 150 days. That clock is now ticking. And what happens when that clock runs out is already being debated behind closed doors. Markets don't wait for the outcome. Markets position for the range of outcomes. And every scenario in that range right now is supportive for precious metals. If tariffs hold, inflation expectations stay elevated. If tariffs get reduced, growth expectations improve and industrial demand accelerates. Either way, silver wins. That is not a coincidence. That is the structure of the trade. Now look at the dollar. Friday saw the dollar index dip 0.14% to 97.75. It was still heading for its strongest week since October, but it dipped on the day. You already know what that means. When the dollar weakens, gold and silver move up. When the dollar strengthens, they pull back. But here's the nuance most people skip over. The dollar was strong for the week, and silver still ran nearly 6% on Friday alone. That tells you the bid underneath silver right now is not just a dollar play. There is something structural happening here that is bigger than the currency move. Treasury yields moved too. The 10-year landed at 4.083%. The 2-year came in at 3.48%. Those are numbers the Federal Reserve watches closely. And speaking of the Fed, Governor Christopher Waller is the first Fed speaker of the week. His comments hit Monday at 8:30 in the morning Eastern Time. The market is listening for one specific thing. Is the Fed shifting its focus toward growth concerns, or are they still locked onto the inflation fight? That answer will move yields. Yields move the dollar. The dollar moves silver. You need to know what Waller says before you know what silver does next. That is how the sequence works. Then on Tuesday, February 24th, consumer confidence numbers drop at 10 in the morning Eastern. Consumer confidence is a leading indicator for household spending. If it comes in weak, it signals the economy is slowing. Slow economy means the Fed is under pressure to pivot. Pivot expectations push yields down. Yields down means dollar down. Dollar down means silver up. If confidence comes in strong, the sequence reverses. But given the trajectory of the data right now, weak is more likely than strong, and traders are already positioning for that scenario. Friday the 27th brings the Producer Price Index for January. This is the inflation read from the supply side of the economy. High PPI means costs are rising at the production level. That feeds into the narrative that inflation is stickier than the Fed wants. Sticky inflation means higher for longer rates. Higher for longer rates eventually break something. When things break, people move into hard assets. Silver is a hard asset. This is not complicated. The pattern has repeated for decades. The only thing that changes is the specific catalyst. Now here is what nobody is talking about. Asian markets were closed for the Chinese Lunar New Year. They reopened Monday, February 23rd. Full volume returns to global trading. Chinese physical demand is one of the single largest forces in the precious metals market. When Chinese buyers step back in after a holiday, they step in with size. And they are stepping back in with gold sitting above $5,100. That is a new price reality that Asian buyers will be digesting for the first time in real trading conditions. How they respond to that number will set the tone for the week. If Chinese demand comes in strong, it validates the breakout. If it hesitates, there may be a brief pullback before the next leg. Either way, by the end of this week, the picture will be much clearer. And those who are positioned correctly before clarity arrives are the ones who benefit most from it. Let's address the one counter-argument being floated right now. Some analysts are suggesting that solar manufacturers will start replacing silver with copper as silver prices climb. This argument sounds reasonable on the surface. It is not. Silver is the most electrically conductive metal on Earth. It is the most thermally conductive metal on Earth. It is the most light-sensitive metal on Earth. The CEO of one of the largest copper operations in the world has said publicly that silver is irreplaceable. And here's the logic behind that statement. If copper could replace silver in meaningful industrial applications at scale, it would have happened already. These companies have every financial incentive to cut silver out of their supply chains. They have not been able to do it. Because the performance gap is too wide. You can reduce the quantity of silver in certain applications, but you cannot eliminate it. And while manufacturers figure out how to use slightly less silver in old applications, new applications keep emerging that require more. AI processing chips require silver. Samsung's new silver lithium-ion battery technology charges electric vehicles twice as fast with longer battery life. The latest generation of solar panels now uses twice as much silver as previous models, because engineers figured out that desert sand reflects light onto the underside of panels, making dual-sided panels with photovoltaic cells on both surfaces far more efficient. Twice the panel means twice the silver. Military technology, drone systems, space infrastructure, laser guidance systems, all of it runs on silver. The demand story is not weakening, it is compounding, and the supply story has not changed. Primary silver mining output has been flat or declining for years. The metal does not grow on trees. It has to be pulled out of the ground. And the industry is not pulling enough of it out to match where demand is heading. When markets opened on Sunday, silver was already moving. Within the first few minutes of trading, it pushed up to $85.45. Asian markets were about to come back online. That was before the full weight of the week's catalysts had even started to be processed. Think about what happens as each data point drops this week. Fed speaker Monday, consumer confidence Tuesday, PPI Friday. Each one of those is a potential accelerant. Now here is the moment this video has been building toward. You can be the person who watches this unfold and does nothing. You can be the person who sees the data, understands the setup, and still waits for more confirmation. Or you can be the person who understands that by the time something is confirmed on the surface, the institutional money is already in and the easy part of the move is behind you. The quiet wealth transfer that has been building in precious metals is not a theory. It is measurable. It is visible to anyone who is paying attention. The people who got into physical gold and silver before these numbers hit are sitting in a completely different position right now than people who are still waiting for permission from the same system they don't trust. This week is going to be loud. The data is going to hit. The Fed is going to speak. Asian demand is going to return. Silver is going to respond to all of it. The core principle stays the same through all of it. Physical gold and silver in your hand is not a trade. It is a position against a system that has given you every reason to distrust it. Every piece of data this week, whether it is bullish or bearish for silver in the short term, points toward the same long-term reality. The monetary system is under pressure. Industrial demand for silver is growing. Supply is not keeping up. And the institutions that move first are already moving. The only question left is which side of this moment you're going to be on. The choice is yours. Make sure you subscribe to SHF Money so you don't miss the daily updates as this week plays out. If you're not watching this in real time, you are already behind.